One of the questions that we get when we're talking about the risk management side of financial planning, oftentimes from our clients, is how much life insurance do I need to get? So today we'll focus on the three ways to calculate your life insurance need and to go about your life insurance planning. Before I dive into that, just quickly, I do want to mention, most of you probably know this, but life insurance, like a lot of insurance, is priced based on your age and your health at that point in time. Okay, so again, when you're young and invincible, might not want to get life insurance, but it actually might be the best time to get it. So being proactive rather than reactive can be beneficial sometimes for the long term. Okay, getting into the three ways, I think the first and easiest one is using a factor of your income. I've heard anywhere from 7 to 10 times your income by folks in the industry. I think that's probably a little light depending on where you're at in your life. The CFP curriculum taught me 12 to 16 times income is adequate coverage. I personally believe with that method, you can either underinsure yourself, particularly if you're young with a young family and a lot of big goals, or if you're older and you use that method, you can overinsure yourself. And ideally, you don't want to be underinsured or overinsured. Okay. Other method is a human life value. This, I'll keep it simple. It's more complex, but it's really just a net present value calculation. So it's taking your income today and over the amount of years, let's say you're 25, you're retired 65, and saying over a 40-year period, your income is going to be worth X at this rate of return to your family. So you're going to need X amount today, generating an X amount rate of return over X amount of years to replace all that income that you're currently on track to make to go to your family. Typically a large number, all right? Third and final way, and the way that W3 prefers to work with our clients and a lot of industry professionals prefer, is the needs-based analysis or the capital needs approach. This is where we actually look at, okay, where are you at right now at this point in your life? What are all your assets that you have in place? What are your incomes? Okay, and then what are your liabilities, your debts? Okay, let's make sure we wipe out your debts so that the balance sheet is clean. Sometimes we'll add, a chunk so that the surviving spouse has a nice emergency fund in place, take care of funeral expenses, those sorts of things. And then we'll take care of lump sum goals. The big one is kids' education, obviously. And then a retirement is another goal that we want to address in terms of the needs-based approach. So we'll take those into account, and we'll typically come up with a number that makes sense and that isn't too high or too low. It's really the adequate amount of insurance that you need at that time. And we'll look at a variety of solutions to accomplish that goal, and try and get you the best price, obviously, best bang for your buck in terms of coverage. But like any part of the plan, life insurance isn't a one and done deal. Sometimes it's treated as such. I believe your life insurance should be reviewed just like your investment plan, to make sure that you're not overinsured or underinsured throughout any period. And as you know, life does change over time, so your insurance needs may change over time, and you want to address that. So if you have questions, reach out to an insurance professional or a financial advisor in the area and make sure that your family gets the appropriate amount of coverage.
The Cautious Investor with Ryan Glinn is sponsored by W3 Wealth Management.